Good morning, students. This is chapter number 10, budget, subject economics. Now in this chapter only two topics are left. Today we are going to start one topic, accounts of budget. Accounts of budget. This is given on page number 109. Page number 109. And topic is 10.10. Now accounts of budget. So accounts of budget is prepared in the same way as we are preparing accounts. Trading account, final account, profit and loss account. Debit side, left side is the debit side, right side is the credit side. This is debit side, credit side. In trading account, if you have done final account, in which we are preparing trading account and profit and loss account and then balance sheet. So in trading account and P&L account, in both account, credits, this is the credit side and credit side is considered as income. In the same way, when government is preparing budget, they are preparing their budget on the basis of this called double entry bookkeeping. The accounts which we are preparing or business units are preparing, that is based on the principle of double entry bookkeeping. In double entry bookkeeping, every transaction has two effects, and one is shown on the debit side in one account and other effect is shown on the credit side in another account. In the same ways, on the same principle, government is also preparing budget. So in their account, again similar, credit side is considered as income and debit side is considered as expense. So first of all, from textbook, in order to thoroughly understand the concept of a budget, it is necessary to get an idea of the accounts of budget. And idea you have very well because you are already doing accounts and you have complete, I think, final account you have done. So by the rules of accounts, every budget has two sides. The credit side, where the revenues, incomes of the government are recorded. So this side is considered as income, and here all transactions which are giving income to the government, such transactions are recorded on the credit side. And in the same way, the debit side, where the expenditure of the governments are recorded. So all types of expenditures are recorded on the debit side. And here income. Further classification on both sides is as under. First, on the credit side, means on this side, income side, two types of incomes are shown. One is revenue. Now I am trying to explain the different types of income. So here on credit side we are showing income, and income is classified into two categories. One is revenue income and other is capital income. Revenue income and capital income. Now revenue income. Revenue income are those income which are regular in nature. Which are regular in nature, or we can say that this is known income, and KNOW, and known income. Regular in nature or known income means government knows very well that this type of income comes every year, or from this source this income will come. Known income. Such incomes are regular in nature. And technically, such income neither effect asset nor liabilities. So income which neither affects assets nor affects liabilities, such income is called revenue income. For example, neither affects assets means either assets increases or decreases, neither assets increase or decrease, neither liabilities increase or decrease. There is no effect, there is no impact on assets and liabilities of government. Such assets are regular in nature, and examples are tax, either it is direct tax or indirect tax, tax, fees from different sources, government is collecting fees, then penalty, fine, challan. These are different sources of income and these are regular in nature. Such income is called revenue income, and revenue income is shown on credit side of government budget. Now capital income. Capital income are those income which are irregular in nature, opposite of revenue income, irregular in nature, or we can say unknown income. Unknown income. So capital incomes are those incomes which are irregular in nature or which are unknown income, unknown to government. Now technically, capital income are those incomes which reduces assets and increases liabilities. So any income which reduces the assets of the government and increases the liabilities of the government, such type of income is considered as capital income. Once again, an opposite of capital income, revenue income. Now we can write revenue income are those income which neither reduces assets nor increases liabilities. So any income which neither reduces assets nor increases liability, or in simple language, any income which does not have any impact on assets and liabilities, such income is called revenue income. On the other side, capital income which reduces assets and increases liabilities, such type of income is considered as capital income. For example, sale of assets by the government. Sale of asset is also known as, we have already done in foreign trade, sale of assets, sale of ownership to any other business unit or to any other sector, that is called disinvestment. We have already done disinvestment. So in simple language, sale of assets, when government is selling any of their property to anybody else, against that they are receiving some money, that money becomes income for them. That money becomes income for them, received money becomes income for them. But what happens? What is the impact of sale of assets? The assets of government reduces. No doubt that this brings income for the government, but what is the effect? Their asset reduces. So whenever asset reduces, whatever money government has received, it is considered as capital income. So sale of asset is an example, or sale of asset or disinvestment is an example of capital income. Now it reduces assets. When we are selling assets, against that whatever money we are receiving, that is considered as capital income. And what is the impact on assets? Our assets decreases, means government's assets decreases. Now second, increases liability. borrowing money. When we are borrowing money means when government is, we are talking about government. When government is borrowing money from any other institution, from foreign government, from foreign companies, when they are borrowing money, cash inflows means government is receiving cash. When they are receiving cash, it is considered as capital income. That becomes income. But what is the effect? Their liability increases. When they are borrowing money, liabilities increases. So these are the two examples. One more example, sale of assets or disinvestment becomes capital income for government and borrowing money, it increases liability. So these are the two examples regarding capital income. Beside this, whenever government is issuing shares, when they are issuing shares, whatever money they are receiving, that is called capital income, and issuing shares becomes liability. Share capital, according to balance sheet, share capital is shown on liability side. So it increases the liability of government. So once all these incomes will come on the credit side, whether it is revenue income or it is capital income, both will come on the credit side of government budget. Revenue income, once again, which are regular in nature, which are known income. For example, if we take our example, whatever income earned by your parents in the form of salary, that is revenue income, regular in nature. Every month they are receiving salary, a fixed salary. That is called revenue nature. It does not affect assets or liabilities of your house. Neither your assets will increase or decrease, nor your liabilities increase or decrease. So salary is an example of revenue income because it is regular in nature. It is known income. On the other hand, capital income, if you take the example of capital income, suppose if you are selling your property, any property, your house or any fixed asset, for example, vehicle. So whatever money you are receiving, that is irregular in nature because every year or every month we are not selling the same property. That's why that is unknown income, irregular in nature. And by selling our property or any vehicle, it reduces our asset. That's why it is called capital income. In the same way, revenue income, which are regular in nature, which does not affect assets or liabilities. On the other side, capital income, which are irregular in nature, it reduces assets or increases liabilities. And both income will be shown on the credit side of government budget. Now in the same way, expenditure. Second topic is expenditure. Now expenditure is also classified into two categories: revenue expenditure and capital expenditure. Now expenditure is also of two types: revenue expenditure and capital expenditure. Now revenue expenditures are those expenditures, again same definition, are those expenditures which are regular in nature, or we can say it is known expenditure, known, K-N-O-W, and known expenditure. Means these are the fixed expenditure which government has to incur in different activities. So expenditures which are regular in nature, such expenditures are called revenue expenditure. It, again same definition, it does not affect assets or liabilities of government. For example, salary paid to government employees this is an expenditure for government. Salary paid to government employees is a regular expenditure for the government. That's why it is called revenue expenditure. It neither affects assets nor affects liabilities. On the other side, capital expenditures are those expenditures which are irregular in nature. Irregular in nature means unknown expenditure. Or technically, expenditures which reduces government's liabilities and increases government's assets are known as capital expenditure. So expenditure which reduces government liabilities and increases government's assets, and reduces government liabilities. Such expenditure is called capital expenditure. For example, now first of all we are taking example of reduction in government liabilities. Suppose government has borrowed money from foreign government. Suppose 5 lakh they have taken as a loan from government foreign companies. Now they are repaying those liabilities. When they are repaying those liabilities, cash outflows. As a result, their liabilities, our government's liabilities reduces. Why government liabilities reduces? Because they are repaying. They are repaying the borrowed money. So whenever they are repaying the borrowed money, borrowed money. When we are repaying, it means it becomes an expenditure, and this repayment of borrowed money reduces liabilities. Repayment of borrowed money. Now increases government's assets. How increase in government's assets become an expenditure? For example, recently Indian government has purchased Rafale from France. So we are purchasing aircrafts from France, and for this we need to make payment to France government. It becomes an expenditure. But purchase of Rafale increases the government's assets. So purchase of assets, any kind of assets, aircrafts, ship, technology, or any other goods, whenever we are purchasing from any other institution or any other country, then it means it increases the assets of the government, it increases the assets of the nation. So whenever there is increase in government's assets, it means we need to make payment for that. We need to means government needs to make payment for that, and that payment becomes expenditure. And which type of expenditure? Capital expenditure. So purchase of assets, like for example again purchase of aircrafts from France government is an expenditure for Indian government, but such expenditure is called capital expenditure as it increases our assets. So once again, expenditure which reduces government's liabilities, for example repayment of borrowed money, and increases government's assets, for example purchase of assets, are known as capital expenditure. And these are irregular in nature, because regularly we are not purchasing aircrafts from any other country. That's why this is called capital expenditure. But both expenditure, whether it is revenue expenditure or capital expenditure, both will be shown on debit side of government budget. So accounts of budget is completed. Once again, budget is based on double entry bookkeeping on the basis of principle of double entry bookkeeping. It has two sides. One is debit side, other is credit side. And credit side is considered as income, means all types of income will be shown on the credit side, and all types of expenditure will be shown on the debit side. Now theoretically, income is of two types: revenue income and capital income. Revenue income, which neither affects assets nor affects liabilities, are called revenue income. In simple language, regular income are those income which are regular in nature, which are known to government. Such income is called revenue income. And capital income are those income which are irregular in nature. And capital income, other definition, are those income which increases liability and reduces assets. Means any expenditure which increases the government's liability and decreases the government's asset, such type of income is called capital income. On the other side, expenditure, second point, expenditure. All types of expenditure will be shown on the debit side of government budget. Now expenditure is also of two types: revenue expenditure and capital expenditure. Revenue expenditure are those expenditures which are regular in nature, means revenue income and revenue expenditure both are regular in nature, and it does not affect assets or liabilities of government. For example, salary paid to government employees is an example of revenue expenditure. On the other side, capital expenditure are those expenditures which are irregular in nature. Again, capital income and capital expenditure. Capital income and capital expenditure both are irregular in nature. Now technically, capital expenditures are those expenditures which reduces government liabilities and increases government assets, are known as capital expenditure. For example, repayment of borrowed money, purchase of assets. But all expenditure will be shown on debit side of government budget. Now last topic, only points I am writing, then explanation in next lecture. Types of deficit budget. Deficit budget we have already done. Deficit budget are those budget in which expenditures are more and income is less. Whenever expenditure is more, income is less, then it is called deficit budget. So these are of different types, or we can say at different level. When we are measuring deficit budget, it has different names. One is revenue deficit. Revenue deficit budget. Revenue deficit budget. Second one is budgetary deficit. Budgetary deficit. Third one is fiscal deficit budget. Fourth one is primary deficit budget. First, revenue deficit, budgetary deficit, fiscal deficit, and primary deficit. The 4 types of deficit budgets are there: revenue deficit budget, budgetary deficit, fiscal deficit budget, primary deficit budget. Explanation in next lecture.